If you've been paying attention to the headlines lately, there's a new word creeping into the conversation: recession. And today we're going to break down what a recession could actually mean for the housing market. And no, it's not automatically a doom and gloom crash scenario like some people are already hyping up. After that, if you've been feeling like the American dream of homeownership is slipping further and further away, you're not imagining it. A new report just dropped showing how much a family of 4 would need to earn in every state to afford a basic 3-bedroom home. And the numbers, well, they're pretty interesting to say the least. I'll cover how California ranks among the union, how much this report suggests a family of 4 should be making, and how it compares to our prices here in San Diego. This and more covered in this week's San Diego Market Matters, and I'm Karl Kyler, your San Diego Realtor. If you're enjoying the updates in these weekly reports, be sure to like and subscribe to my channel if you haven't already. And if you're thinking of buying or selling here in San Diego, I have my contact info in the description below. Let's connect and see how I can help you make your next move happen for you. Now, let's get into the good stuff. Quick market check-in. The PCE, the personal consumption expenditures metric, the one the Fed uses to measure inflation, is sitting at 2.5%, and unemployment is strong at 4.2%, showing stickiness in that low 4 handle since May of 2024. GDP is at 2.4 at the moment, but this is expected to change after the Q1 GDP report reports at the end of April. The next Federal Open Market Committee, FOMC meeting, is May 7th, and it looks at the moment pretty certain that the Federal Reserve is going to stand their ground and hold interest rates as they are, which makes sense. GDP is still doing well, inflation is kind of sticky in the mid 2.5 range, and unemployment is still in the low 4% range. Like, there really isn't a need for them to drop rates yet. Lastly, mortgage rates. We had a bit of volatility there with all the tariff talk. Despite all that, rates are still holding just below 7%. Now, let's dig into all this recession talk. This new wave of recession talk is coming off the heels of President Trump's new tariffs, which has a lot of Wall Street very, very nervous. Stocks have already taken a huge hit, more than a 12% wiped out in just a few days. And big names like JP Morgan Chase and Moody's are now saying that the odds of a recession this year have jumped to around 60%. Now, recession fears don't automatically guarantee one is coming, but even a threat of a slowdown can have real effects on the housing market.
You gotta be kidding me.
Because buying a home is such a massive financial commitment. When people are feeling uncertain about their jobs or their investments, they tend to pull back on big purchases like real estate. If we do hit a recession, here's what the experts say we can expect. Home sales, which are already pretty soft, would likely pull back even further. Now remember, last year we had the slowest home sales nationally since 1995. So while there's still technically room to fall, it wouldn't be the cliff drop some people might expect. The market's already operating at a slower gear. Prices, on the other hand, could start to feel some downward pressure, but it'll depend heavily on where you are. In places like the South and the West, where home inventory levels have surged, prices could start to soften a bit faster if buyer demand falls off. But in areas like the Northeast and the Midwest, where inventory is still pretty tight, we might not see prices budge as much there. In fact, a pullback in buyers could actually help to rebalance those markets a little bit. One important thing to keep in mind though, unlike 2008, most homeowners today are in a very strong equity position. Over half of all mortgages are locked under 4%, and homeowners have built up a massive amount of equity gains over the last few years. Even if home prices fell 10 or 20% across the board, and I'm not saying they will, homeowners would still be sitting on equity levels similar to 2019 or 2021. So this isn't a house of cards waiting to collapse like the 2008 world financial crisis. It's more like a market that might exhale a little bit after years of tight supply and affordability strain. Now, let's talk about mortgage rates, because here's where things could actually get interesting. Historically, mortgage rates tend to fall during a recession. As investors pile into safer assets like bonds, yields drop and mortgage rates usually follow the 10-year treasury pretty closely. We actually saw a glimpse of this in April when mortgage rates dipped to their lowest point of the year, even if it was short-lived. If the economy does slip into a recession, it's very likely we'll see rates come down further, especially if the Fed feels pressure to loosen monetary policy. But, and this is a big but,
I like big butts and I cannot lie.
Lower mortgage rates won't magically solve affordability issues if people are worried about job security. If buyers don't feel confident about their financial stability, it won't matter if rates are at 5 or 4.5%. A lot of them will still sit on the sidelines. So what's the takeaway here if you're thinking about buying a home? Be smart. Don't stretch yourself thin just because rates dip. Make sure your mortgage payment is truly comfortable, not just in today's market, but even if the economy softens. And definitely have a strong emergency fund built up before you jump in. Stability and flexibility are going to be key if things get bumpy. So now it's an opportunity for us to hear your thoughts in the comments below. Do you think a recession is coming this year? And if it is gonna hit, do you think it will finally cool off the housing market in a meaningful way, or just give us more of the same slow grind we've been seeing lately? Now let's jump into Realtor.com's recent report on housing affordability at the state level. Realtor.com reports on how much a family of 4 in every state needs to earn to afford a home. What is really interesting in this article is that Realtor.com took into account the average wage in every state, as well as the median home price, and then determined an affordability factor. This gives really great insight as to how markets actually compare to one another. And what will surprise you most is one of the top least affordable states. I can't imagine anyone in 100 years would have guessed this state to have made it into the top 3 least affordable. Now let's talk about California first because, well, we're right in the thick of it. According to Realtor.com, a family here needs to earn $209,000 a year to comfortably afford a median-priced home. This is based off of a 10% down payment and an interest rate at 6.65. This also factors in a mortgage payment at about 45% of the gross yearly income. Something to keep in mind here is that a mortgage over 30% is considered cost burdened. The reality, the typical family income in California is $128,000. This is based off the median home price of $728,000 as per Realtor.com's data. That's almost a 39% gap between what families actually make and what they need to buy a median priced home. It's no wonder why so many people feel priced out. How does this compare to San Diego? Our average price is around $1 million, and a 2023 survey reported that the average household income in San Diego was $139,000. If we assume a 5% increase year over year, average household income might be around $150,000 to $155,000 per year now. With a 45% debt to income ratio with the mortgage only, that means no other debt, that would equal a purchase price of about $900,000. Crazy, right? Our estimated average income isn't even enough to keep up with the average purchase price. Well, California isn't even the worst of all states. Hawaii takes the top spot. Families there need over $229,000 a year to afford a basic home, and their incomes aren't even close to that. Montana, Idaho, and even New York are right up there too, all with huge gaps between income and affordability. Meanwhile, if you're wondering where things are a little more sane, it's in the Midwest. States like Ohio, Michigan, and Illinois are killing it when it comes to affordability. In Ohio, the typical family actually earns double what's needed to buy a median-priced home. Imagine having that much breathing room after buying a house. It feels like a fantasy compared to what we experience here in San Diego.
My world is fantasy.
Nationally, 35 out of 50 states plus DC now require a 6-figure income to afford a basic family home. That's how serious the affordability problem has become. Even though nationally families are making about 4% more than what's needed to buy a home, places like California and Hawaii, the gap has become a canyon when it comes to affordability. Now, what's interesting to think about is this: with the rates still bouncing around in the high 6% range and inflation still sticking around, the pressure on affordability isn't going away anytime soon. Unless something major shifts with home prices or incomes, and I'm not holding my breath, we're probably going to see even more people priced out or forced to get creative with how they buy their next home.
I don't believe this.
So here's my question for you. Do you think affordability is going to improve anytime soon here in California? And if you do, how do you think that will happen exactly? And that's a wrap for this week's San Diego Market Matters video. Thanks for hanging in there with me. If you enjoyed what I bring in these videos and haven't subscribed yet, consider doing so now. But if you're still to be convinced, check out some of the other content. I'll post 2 videos here that might win you over. Go ahead and check either of those out. As always, I'm Karl Kyler, your San Diego Realtor. I'll see you in the next video.